very special Profit Matters session today. Got a major new announcement and a major new member benefit we're going to be talking about today, and a really exciting opportunity to really put money into your pocket. And it's really a fabulous opportunity. I've got a new partner that we're going to introduce to you today who's going to help you do that. And we're going to be talking all about those details as we go through the webinar today. The subject matter is called the ERC. It's called the Employee Retention Credit. And the Employee Retention Credit, if you remember back during the pandemic, the WFCA spent many sessions of webinars talking about the CARES Act. It was the act that provided all the financial assistance to businesses and individuals during the height of the pandemic. And of course, during that time frame, we talked at length about the PPP loans. We spent a lot of time talking about PPP loans, but we never did talk about a really little known portion of the CARES Act that was introduced back then called the Employee Retention Credit, or ERC. And there's been several changes in legislation since the initial CARES Act was enacted that modified the ERC and have made it become much more available to most people, quite honestly. And so that's the reason we want to talk about it today. The statistics that I looked at most recently had about 10%, if my numbers are correct, of eligible businesses across the country. Only 10% of those roughly have taken advantage of the ERC. And it's government funding right to your bottom line. And so we'll talk about all of those things as we go through the session today. Let me first introduce to you a partner that we have that's going to help us get you through this process. And the company is called Layton. And we have on the webinar today going to be joining us and taking us through the process that we're setting up to help you get access to and get this ERC credit claimed for your business. We have Brandon Carroll, who is on the screen, I think now, on the left-hand side. And we have Maggie Crowley. Both of them are going to help today take you through a presentation to show this, but also be here to answer any questions you might have in regards to the Employee Retention Credit. This is a new member benefit for us. We have established this partnership and relationship with Layton. We have a special negotiated rate for our members for the fees that are involved, and there are fees obviously involved in helping you get through this. It's a fairly complex process. But we have very special partnership with them, special rates that we've negotiated, special terms, and they're going to be a great partner for us. They've got a lot of resources. They're in a lot of cities, and very good company. They've got a whole division really that is set aside just for the ERC credit. So without further ado, I'm going to actually turn it over to Layton and let them further introduce themselves and show you what this is all about and how we're going to be able to help you take advantage of this great new opportunity. Who's going to take it? Brandon, is that you?
Sorry, I thought I was off mute.
Oh, Maggie, there you go.
Well, it's going to be both of us.
Okay, great.
But I first wanted to start by saying thank you and thanks for having us. We're really excited to be working with you guys and working with the association and all the members. And I'm Maggie. I lead our strategic development team. And then my co-speaker and co-host today is Brandon. And I'll let you obviously introduce yourself.
Thank you, Maggie. Yeah, my name is Brandon Carroll. I'm a senior business development executive over at Layton, and also an expert on the employee retention credit. Look forward to kind of walking you guys through the process, what it is, how to claim it, and yeah, we're excited for everyone that's joined this webinar.
So a couple of things before we get into the nuances of the credit. Number one, we've partnered with you guys, I think, because we've been talking with Steve a lot to understand the association, understand how you guys function. And like many other businesses, what's important to you is keeping your business afloat and growing it. Many people suffered from COVID in various different ways. So our goal is to make this really easy and really simple. The likelihood that you guys qualify for the employee retention credit is extremely high. You all have similar businesses. So we'll give you a high level overview of what it is. You don't need to know all the details necessarily. I think what most people care about is understanding the amount of money they can get back. So we have created a great process to make it really simple to take advantage of this tax credit. We hate to see people leave government dollars on the table because they are here. You are deserving of them, so you should get them. So thanks. And we'll drop a link within the chat box in case people have to leave early or something. You can always book a meeting with us to continue to learn more. And please pop questions into the chat box as well during the presentation, and we'll get your questions answered. We want to keep this a more conversational, but we'll definitely have a Q&A at the end as well. So first off, what is this employee retention tax credit? It is a credit that was in response to COVID, and it came after the PPP loan. And what it does is it allows businesses to get a refundable credit against some of the hardship that they experienced during COVID while they were still trying to effectively run their businesses. And Brandon, I don't know if you want to add anything in about the per employee amounts before we explain some of the actual how to qualify.
Sure. Yeah. It's an exercise for companies that have W-2 employees that are on the payroll. The function is actually to refund these businesses for their payroll tax that they pay. But obviously it's a lot more than that. There's a lot more of a refundable credit on top of just giving you back that payroll tax. And as you can see below, there's 2 years that are highlighted, and this is a 2020 and 2021 analysis, and we're stacking up those years against 2019. And basically, there's you can see that there's a 5K cap per employee for 2020, and due to a lot of legislation updates, I think as Steve mentioned before, 2021 brings a whole nother level of value where you can receive up to $7,000 per employee per each quarter, excluding the fourth quarter, but still that's quite a bit. And so that's exactly what the exercise is, and we kind of keep moving forward.
Right. So in order to qualify, it's pretty simple. You have to either have experienced a decline in your gross receipts, or you have to have had your business either fully or partially closed due to a state mandate because of COVID. So keep in mind, it's not both, it's either or. You may have experienced both, but if you only have one of them, you will still qualify for the employee retention credit. So just knowing having an understanding of the businesses and what you guys do, I think it goes with, out even saying that everyone did actually likely qualifies for this credit because of the nature of your work. I'd also like to highlight the importance of taking, if you guys were made aware of this back in 2020 and it wasn't a good fit for you then, it is absolutely worth taking a look at now, because the legislation has changed, and it's changed so that more businesses can in fact take advantage of it. So the likelihood of you being able to benefit from it now, if you weren't able to previously, is really high. And it can also be claimed retroactively. So we can do a study now in 2022 back to 2020. So you haven't lost any money. The only thing to take into consideration is there are different levels of money that you can get back in eligibility based on the size of your business. And I think what is the threshold? It's 500 employees above, where it becomes a bit of a different scenario. And then you can't double dip wages paid for PPP funds and the work opportunity tax credit. But that's our job to be able to discern between where you can use the money and the wages. So Brandon, I don't know if you want to take this one to talk about the interaction with PPP loans.
Yeah, I mean, this is just at a high level. You know, we take a lot of serious approach to this, and you know, our concern is being accurate, following the rules, but at the same time, we don't want to leave any stones unturned. So most companies got PPP loans, whether it was one or two. Some might have not gotten any PPP loans, and in all three scenarios, a lot of businesses can qualify for the employee retention credit. But yeah, if you have most PPP loans, they last there's a covered period. Typically it's 24 weeks. So it's 1 quarter. And the ERC analysis is a quarterly analysis as well. And so we're stacking all of the quarters of the last 2 years on top of the quarters in 2019 and evaluating the percentages of declines in your gross receipts. Most of the time, that's the majority is revenue. And when there is a qualified quarter for ERC that is on top of a similar quarter that you received your PPP loan for, we have a way to basically, you know, exhaust that PPP loan before we start to rack up the employee retention credits. And so we have a way to navigate that, and we take a conservative approach. Like Maggie said, you know, this avoids double dipping, and we spell this out in our analysis and our delivery.
So what we can include when we are, oh, sorry.
Can I just make mention of, just go back to that other slide, if you would. I've just got one question or maybe a comment on it that I think is important to note. You know, a lot of individuals have taken out the PPP loans for a particular quarter or that particular offering of it. But that third bullet about how you apply for forgiveness of that loan is really, really a big issue there in terms of how much access you can get to the ERC credit, because it's not the full amount of your PPP loan that is going to be in consideration with the ERC credit, correct? I mean, it's only the payroll portion that of the PPP loan that was used for a payroll that is actually going to be in play. If you used your PPP loan for rent or utilities or some of the other things that the PPP loan was eligible to be forgiven for, those dollars do not hurt you in terms of the ERC. Is that correct?
That's correct, and that's what we examine. Obviously, there's a lot of different ways that people use that loan money. Yeah. And you know, we want to make sure, obviously, that the employee retention credit is purely based on wage, and so you know, we obviously want to separate the two and do it the right way. Yep.
Very good.
Thanks, Steve.
So just to continue on what we analyze when going through our process, we look at the salaries and wages paid, the tips, if included, within W-2, bonuses, and then health insurance cost. And I know we did speak on it, but the changes in legislation really have impacted the way that ERC can affect and impact a business. And we, as Steve was saying earlier, we've got a team of about 75 folks that are dedicated just to ERC. And that team is comprised of tax attorneys who make sure they know how every single change in legislation will impact anyone claiming the credit across all industries and states. And then we have a slew of tax professionals who are actually performing and completing the calculation and credit. So we have proprietary algorithms that we've built and workbooks to ensure that we're claiming this correctly and ensure that we're claiming the maximum amount that is available to our clients. Like I said before, we really don't want to leave money left on the table for people. You should soak up all that you can get. One thing to note that might be relevant to this group especially is if this is a family run business, and let's say you've got, you're the owner and you've got your two sons or son and daughter or something working under that. Those are salaries that we wouldn't be able to, they'll be ineligible for the credit. So you'll want to take that into consideration as you fill out the form. So the wages of family members we're not able to include those. And so let's put our money where our mouth is. We've been talking about this credit and how it really helps people. We've got a couple of case studies that do truly highlight the impact of this. So this first case study was a business in the education industry. I think I actually think it was a private school. And they had a pretty significant decline in gross receipts for 2020 compared to 2019. And they claimed the first 2 quarters of the year 2021, they had a small PPP loan compared to payroll wages incurred. And they had 108 employees for 2021, and they got back a credit of 1.1 million. So that is hugely impactful. And then this was a study we did we did this case study mid study with this hotel. This was a chain of boutique hotels. They've got about 40 in total. I think we've done about 7 of their hotels. They had a really significant decline in gross receipts, obviously being the nature of the business. I don't think anyone was staying in a hotel when the pandemic first began. And their claiming period was second quarter of the 2021 year. They had regular sized PPP loans, and then their ERC claim was 300,000. So this does depict that the size of the PPP loan will make an impact, and the utilization of the PPP loan will make an impact on the credit. But who's going to say no to 300K? Money's money.
Good money.
And if anyone has questions, please pop them in the chat if anyone wants to, or chime in. I don't know if your mics are available, but please ask questions about these case studies, because we are here to answer them. So a little bit about why, when we present, people are often wondering, well, why wouldn't I just use my CPA for this? That's who I trust with the rest of my tax matters. And we do understand that, and we get it, but this is a new part of tax. This is, of course, a tax credit that's in reaction to the global pandemic. So it's complicated. The rules keep changing. We've got a team dedicated just to this. And the window for this to be looked at has been increased by 2 years. So the normal window of the statute of limitations is 3 years. This has been extended to 5, which I think they've done that for various reasons, but part of it might be that they are going to be taking a look at this in the coming years to make sure people have done this correctly. So logically you'd think, let me do it correctly. And that's what working with a firm like Layton can ensure, that you are doing this correctly. There's not going to be an issue if someone comes back with a question about it. And if there is, you've got Layton on your side to support you through that. So I think it's just ease of mind, and then also just easy for you guys. We want to make this as easy as possible. We've got some pretty cool technology that we've built to allow you to upload your documents seamlessly and easily without having to hop on a phone call. You can just do it on your time. And so if we end up getting the pleasure to work with you guys, the first thing that you'll do is you'll have a conversation with Brandon or someone on Brandon's team, and we'll get to understand your business a little bit better, how you were impacted. And then we'll share that letter of engagement that has the pre-negotiated pricing that we determined with the Wood Flooring Covering Association. And Steve, I think you owe a big thank you to Steve because he's a pretty good negotiator. So what we'll then need is for you guys to upload your quarterly P&L statements for 2019 and through 2021, your payroll report, and then your PPP forgiveness loan application.
Vote me up there. So Maggie, can you elaborate a little bit on what you go through or what you have to substantiate the options that you qualify for? In other words, what documentation do you need? I mean, if it's, let's say it's a government mandate of a closure, how do you substantiate that in this process?
So there's a few different ways. If it's a government closure, we have a library in most cases that we can pull from that proves that there was a mandated closure. On other times, we'll need to rely on the client to provide us with a letter or an email or some sort of proof of it if we don't already have that on file. I think a lot of businesses are actually mailed a physical letter that notifying them of the need to close their business for a particular period of time. And then in the situation of gross receipts, if there was a loss in it, we'll just need to analyze these documents that we need to look at anyways. So your P&L will highlight the drop in gross receipts.
Very good. And that's on a quarterly basis, year over year, quarter over quarter.
It is
it's year over year, right?
It is. So we would look at 2019. Let's say if we were trying to understand if Q1 in 2020 was eligible, we would compare that to Q1 in 2019. So it's measured on a quarter by quarter basis. So we would parse everything out into individual quarters.
So you could qualify for one quarter and not another, for example, in both of those qualifying conditions, a drop in business and or a mandated impact to your schedule or hours or something along those lines. Is there any provisions for impact from the supply chain? You know, in other words, if you have an impact with someone in your supply chain not being able to provide product, which is going to be one of the big things, I think, in the floor covering industry. We went through a period of time there where product was difficult to get because of supply chain issues. You know, the ports were closed and things of that nature. Do those come into play in terms of qualifying?
Yeah, they absolutely do. So if there were supply chain issues, or I think a good way to think about this is if there was a pretty significant impact to your business and your ability to actually complete your work in a normal way, then you'll be able to qualify for this. So when it comes to supply chain issues, if you weren't able to get the materials that you needed in a timely fashion, if you guys have the paperwork to actually substantiate that, we'll be able to include that within the study. So some of it, I mean, it does rely on, being able to show that lag. So the standard in 2019, and then the lag that you experienced in 2020 and 2021.
Yeah, very good. Yeah, and we do have a series of, targeted questions when we go, the goal for all these, all the companies that want to see if this is something they're eligible for is to have an initial assessment with us, and kind of the first step is getting these documents available to us so that we can analyze those, and then having that assessment. And during that assessment, we're going to walk them through some qualifiers on a shutdown and all the different ways how that shutdown might play out in their favor. And if not, if there's some other things that we need to find out, we'll send them on, we'll point them in the direction of what to look for. So we're going to be guiding them through kind of every scenario that can play out to help them.
Very good. Very good.
One thing I wanted to just note is that Olivia's dropped this link into the chat, and this will live on the website as well, the wood flooring website, in the same area where you were able to book for this webinar. If you guys click this link, it'll take you to a page where you can start the process. So you can select a time where you'd like to take. It takes about 15 minutes, but we've scheduled 30 just in case someone has a lot of questions. And you can select a time that's going to work for you. It'll adjust to your local time zone. And then you just give some preliminary information. So name is Maggie, email is, I'm just doing a quick test here. Oh, all right. I guess you cannot put in an invalid email.
Got to be valid.
And then you have to confirm it. And then company, phone. I definitely should have done autofill for this. I just want to take you guys through the whole process. Sorry, this is a little. And then we'll ask how many employees you have. So let's say you have 25, 20. And then if you can put in here Wood Flooring Association, that would be great. It'll automatically link, it'll notate that it is. And then the purpose is to talk about ERC, or maybe you have a question, like you love Brandon's shirt, you want to know where he got it from. And then you click done. And your booking is finalized. And then you'll get an email based off of the email that you sent. So it's easy as pie. And then you'll have a conversation with likely Brandon, and then we'll get you on your way. We'll send you a link after that call, and you'll be able to start uploading your documents.
Very good. Maggie, I'm just going to correct you just for the record. It's World Floor Covering Association.
Oh, sorry. Sorry.
It's been, you know, the
I
W
keep
gets
saying
messed
wood.
up
I'm
all the
sorry.
time, so no worries.
Way
no
beyond
worries.
wood. It's like
Yeah, wood's included. No
Wood's
no worries there. We're
Sorry.
product agnostic, but nevertheless, we're the World Floor Covering Association. I would just, well, go ahead, and then I've got a couple of comments, maybe some questions additional, and hopefully some questions will come in if they haven't yet through the chat. If you've got questions, be sure to put them in the chat, because we want to try to answer as much of those as possible. But Maggie, go ahead and.
Sure. Well, I wanted to just give a little insight to who Layton is and why the World Flooring Covering Association chose to partner with us. So we've been in business for over 20 years now. We've got 35 offices. I know it says 34, but we keep opening them up. And there we have a bunch in Europe, Canada, and then here in the United States. And you know, what we do in each country is we identify tax credits that are hugely beneficial, but also complex to that particular community, and then we build our business around it quickly. So we our true passion is to help people maximize the amount of money that they can get back from the government for funding overall. And it's, you know, what we've been really successful with it throughout. We have other tax credits aside from ERC that we specialize in. And before ERC was even really widespread within the US, during the pandemic, we were able to identify $1.5 billion in savings for our clients. So, I mean, this is tax credits work. We can't urge businesses enough to just take advantage of these, because that's money that it will go away if you don't utilize it. So that's who Layton is. We can't wait to work with you guys. I'll flip to the next slide, which is intended to spark some conversation and questions.
Yeah, let me just recap a little bit and say a couple of more things before we start taking questions, if there are any. But you know, this to us, as we began to look at this credit, quite honestly, we looked at it for the WFCA. We actually are in the process of going through this application to get ERC credit for the WFCA. We do have eligibility, and the changes that were made subsequent to the initial approval of this in the legislature, they added the ability for nonprofits to get it. So we are also ourselves, doing this same process that we're hoping that you will do, because there's a lot of money laying on the table. And when we realized just how much it was, and how few businesses that are taking advantage of it or even know about it, or maybe they know about it, but they think, there's no way I could qualify because, my business went up during the pandemic. And that was the case for the flooring industry as a whole on the latter end of the pandemic. But initially we saw a major drop in business as activity, was curtailed by legislative changes and restrictions that were there. So we decided that we needed to put something together to simplify the process, to bring a partner in that really knew what they were doing in regards to this process, because it can be complicated. It's not something that we would even try to tackle on our own. I mean, I looked at it originally and I said, no, this is not something we can do. Even for WFCA, we're outsourcing that because it can be a complicated thing. And you need a partner that can really understand the whole thing, both in terms of your qualification as well as the ability to correctly calculate what credits that are due. I wanted to also mention that there's really no risk to you in this process. There is no cost to you if you don't qualify for a credit. You're not having to pay somebody to calculate something that you may or may not be eligible for. If you're not eligible for a credit after they go through the assessment and so forth, there's not a fee. It's based on a percentage of what you actually get back. So there's really no risk in this whole process for you. And I think that's important to note because we don't want to have you expend money on the hope of getting something. That's not what this is all about. As you were going through the opportunity there, I thought about our constituents, our members out there that are running flooring stores all over the country. If you just have 10 employees, the potential credit that is available, not saying that you would get all of the credit, but some of you might. But the credit is up to $26,000 per employee over the course of the period that it's eligible for. I mean, that's $250,000 worth of potential direct credits on your FICA taxes and your Medicare taxes. So it's a huge opportunity. It's a lot of dollars. We're not talking about something that's just a few $100s. This is tens of thousands, in some cases, hundreds of thousands of dollars of potential assistance direct from the government that never has to be paid back. It's not a loan. This is a direct credit refund of your payroll taxes. So I just mentioned that to say that this is something that you have no reason not to inquire about. We're making the process very easy. This link that we're posting here is also going to be, of course, on the WFCA website. So you can access all of this through the WFCA. And we hope you'll take advantage of it and really don't leave any of this dollars on the table. There's a lot of money still out there. And right now, so far as I know, y'all correct me if I'm wrong, there is no cap on the dollars that were allocated to the ERC credit. It was only a time period that has been restricted. The dollar amount, I don't believe, has been capped. Is that correct?
As far as the amount that you can get back?
No, the government funding of this, the overall government funding. Did they have a $1 trillion limit or anything like that? I don't believe they put a limit on it.
No, I don't think that there's a cap.
Yeah.
And we've
like the PPP loans had a cap. They had to get multiple rounds of funding for that. But this one, they didn't put a cap on in terms of like the dollars are there if you're eligible for them, and there's no cap that's going to dry up because everybody's got it. So it's going to be available. You just got to go after it. You just got to go after it.
And
That's
we've
correct.
been-
Yeah.
we've
So
been so
can we,
surprised sorry.
yeah, can we jump to Q&A now? You ready?
Yeah, sure. I just wanted to mention one thing, which I think you said in the beginning. It's sort of like insane to hear how many businesses have not taken advantage of this. And I think people aren't doing it because it's, I mean, you hear about it, right? And you hear maybe even this webinar and you're like, God, this sounds confusing. I don't know if I qualify, but I have to urge, just find out if you qualify and then do it if you do. Because even if you're getting back 100K, that's totally worth it.
Oh, yeah. Yeah. Would you say that in your experience, I mean, I don't know if you have this number available or you could expound on it, but in your experience of the clients that you have helped, what percentage of them that you have had an initial consultation with, done an assessment of, what percentage of them qualified for at least something? Do you have that number or even an estimate of that?
I think the qualification rate is, it's pretty high.
Yeah.
Usually there are times if like there's only 1 or 2 employees, it's not always, that's where it's probably not
Right.
necessarily a good
Right.
use of time. And then we'll see some folks who didn't know about the rule about family members. And maybe that's like, that could be half of their staff. So then,
That's right.
but
That's right.
that's not always deterrent.
Yep.
They made it pretty easy to qualify because they want people to get back on track and they want businesses to like get back to where they were pre-pandemic. I mean, if you think about what this does for the government, is it allows businesses to like continue to thrive. And that's what that is what we want for the economy.
Yeah, we find that a lot of companies don't think they qualify because they've just gone through the standard revenue declines. They haven't really done a shutdown analysis. And so there's a lot of CPAs we've partnered up with, even just because they just don't have the bandwidth also to kind of dive into the whole shutdown criteria and all that. And so we are willing to allocate all of our resources to examine all the financials. And if you don't, at least you tried, you hired a professional to do your due diligence. And that kind of brings me to the next thing is, let's have a conversation, because my goal is to have, is to talk with these businesses and figure out, should we take the next step or not? There are some times where I have a conversation and based on maybe they only have a small amount of employees, maybe it's a complete family business or whatever. Maybe I'll say, hey, you know what, this might not make sense right now. But by and large, a lot of times the suggestion is, well, it sounds like there might be some close numbers, or this quarter's a winner. Let's definitely examine, and then we'll take the next step. I mean, we're gonna run our, like Maggie was saying, our analysis on all the legislation updates, all your numbers. I'm seeing some really good questions come through here through the chat. Someone doesn't have a profit and loss statement. That's okay. There's some records that you keep as a business for how you track your income, and whatever that is, just let us know and we can work with you on different formats. Yeah,
just in answering that question. So if you don't have an automated system that produces a P&L, which is the case in a lot of small businesses, they don't go to that level of sophistication from their accounting side. But yet they do have to file taxes, which would show revenue and expenses in their taxes year over year. And if you can segment that by quarter, which is really what you have to be able to do, then you can compare them, and you have that comparative from your P&L. So I think that's, like you said, there are other ways to get access to that information without what I would call a formal P&L. But I'm sure you guys can work through that. Can we look at some of the other ones that are top? I know several have been answered, but I just want to go back through them and just make sure that we're getting it. So the question was, can you explain what happens on the discovery call? Right. And I guess this is after you put the inquiry form information in and submit it, and you connect up with Brandon or his team. You want to just touch on that?
Of course. So, that discovery call is really just going to have me getting to know your business, running through a couple of those initial qualifier questions, how you guys were affected by COVID, some high level revenue estimations. If you have your numbers in front of you, great. But if you were really impacted, you probably have some estimates on how quickly you climbed out. Are you still climbing out, or did you have to shut down? How many employees? That kind of thing. Basically, it's really just a good introductory discovery call, like we're saying to say, should we go to the next step? Should we run through the financials and have everyone look at it, and then set up a call to really go some additional due diligence questions on the shutdown. Let's check every angle, because there's a lot of angles that people have missed. And let's make sure that we're not, leaving anything on the table. And more times than not, that there's a way that we can have you qualify. And if not, then like I said before, at least you've done your due diligence. There might be some other tools out there in the tax world that you've overlooked, and maybe there's something else there.
Very good. Got a question. Can you scroll up just a little bit there? I think there's a question above that right there. Oh yeah, on the fee. Yeah, the fee. We're not going to disclose actually on this webinar what the actual fee percentage is. We negotiated that. That's sort of private and proprietary to what we've worked out with Layton and the WFCA, but we have worked out a fee structure that is uniform for everybody, and it's been negotiated to a really very, very good rate for you, considering what others might charge you to go through the process. But when you connect up with Brandon or his team, they'll go over that with you and tell you what all that will be. But it's the way it's structured is it is a percentage share essentially of your rebate amount. So whatever dollars of rebate you're eligible for, the fee would be a portion of that. And again, Brandon can go through all that. We don't want to put the actual figure on the webinar because it is public. I'm sure you can understand that, but we'll give you that as soon as you give a call or put the inquiry form in. We'll be happy to provide that with you and tell you how that works. But I would also say, just in terms of the process, I know we get a lot of questions sometimes. I have had questions about, well, what do you do? How do you actually get the rebate? That's oftentimes a question. And that I would say is, it is once the calculations and the substantiation of eligibility is all figured out with the help of Layton here, there will be a need to file a 941X form, which is essentially an amended 941 payroll tax form, which will trigger the rebate amount due back to you. And it is actually paid back directly from the IRS with a check back to your business. The IRS has to process that refund. And you can imagine the volume that is coming through with this. They're going to be several months out in getting that, just setting your expectations of that. But that should not at all hinder you from getting the application in and getting that due back to you. Because again, the money is substantial.
Absolutely. Yep.
What other questions do we have? Let's see. If you got a question, be sure to post it on. I don't see anything.
I'm seeing something. We have a paymaster that processes the payroll of several companies, each with their own FEIN numbers. Do you look at each company individually or together as a whole?
Great question.
That's a good one. We get that a lot. So a lot of this goes back to ownership structure, and there are rules for the ERC credit where if anybody owns 50% or more of other entities, then we have to treat those as an aggregated study. If it's less than 50%, we can treat them separately. So that could be good or bad. And I say that because I guess the one limit or cap in this credit really is more about your head count, right? So if you go past that 500 employee mark in 2020 or 2021, different rules apply. And in most cases, your credit is not as large. And that's just, the IRS's way of protecting themselves, of shelling out billions and billions of dollars of paychecks, right? So this is really for kind of that mid to small size business. that was really impacted, right? That the core businesses of a lot of the whole country here. And so so basically, you know, we'll treat the ownership structure on whether we need to group all the companies together, and that could in fact blow your employee retention credit up and give you a much more sizable number. And or if it goes over that 500, that's okay too. We'll just apply the different rule sets. And so it really comes down to the ownership structure of who is a 50% or more owner of how many different entities.
Got another good question here about taxes. Is the rebate taxable?
That is a great question. So in addition, let's say you have $200,000 credit across 2 quarters. So you're going to amend those 2 quarters, get that refund. Now that is treated as taxable income. So a part of that process is also amending those tax returns to make sure that you can account for that additional income. And part of our delivery, along with that financial report showing how and why you qualify, the methodology we used, is also very detailed instructions for how to amend your returns, where to put what numbers. We're not going to fill the forms out for you, but we will work alongside you or your CPA, whoever you're going to hire to do the actual amending. We will help them out if they need help, and our instructions are very detailed on how to do that.
Yeah, and that's an important thing to know. It is taxable income because you deducted those payroll taxes from your operating, from your operating revenue, which was an expense to the business when it was deducted. This is a refund of those taxes. So generally speaking, again, you'll need to get advice from your tax preparers on actually how, what needs to be filed in response to that. But we believe it is taxable income. Yeah, because you've deducted it before. But even so, if you got to pay taxes on it, it's still, you're only paying a portion of what you're getting. So it's well worth it, but it would be likely taxable. So when would the fee be paid? Once the rebate comes through? That's a good question. And that was part of our negotiating with Layton, is the fee schedule. And I really like not to put that on here as well. That was part of our negotiation. In the fee, we negotiated favorable terms and a delay, I will just say that, in when you have to pay the fee portion of it. And I'll let Brandon cover that with you as you have that initial consultation with him. Again, we're trying not to disclose everything that we negotiated with them, but understand that we did negotiate that portion of it, because you will have a schedule to pay the fees that'll be favorable to you.
Absolutely. Yeah, we want to align.
It should align with when you're receiving your funding back from the government. So the hope is that you're not
cover that in detail, I guess, when you have that initial consultation. Yeah.
So please book a meeting. We'll tell you all about it.
Yeah. Okay.
We do have 2 other questions in the other chat box.
Okay.
So the first one from Janice is, I'm assuming you would help those of us who might have deferred payroll taxes that were paid in a later period. To be honest, I'm not totally sure what the question means, but yes, I'm confident that our experts can determine and advise if we can't directly help.
Yep, absolutely.
And then the second question from Paul said it would be difficult to go back and research 2020 through 2021 to determine which specific jobs were lost due to material delays. Is it possible to use an industry average of material delays to determine the lost revenue? For this, absolutely. You guys this isn't the only industry that was impacted. There were plenty of industries. So we've formulated, several different sheets and statistics about the impact around COVID that we can use when submitting and putting this claim forth for you guys. So we will need some information, but we'll certainly be able to make it work.
Very good.
I think
You
that's
have
all
any
the
other-
questions.
Is that all the questions we have in both chat, Q&A and the
Mhm.
chat? All right, very good.
All good stuff.
Any parting words for Brandon or Maggie you want to wrap up with?
I would just say, kind of harp on what we've been saying before. It's worth checking it out. It's worth having someone run all the numbers. If you're worried about the data that you have, we can work with you together to make sure that we can gather stuff that is gonna work. And I think that, like you said before, Steve, there's still a large percentage of companies that have not looked at this all the way. We get it.
Yeah.
Everyone's busy running their businesses. You're still trying to get back on the horse here and get things up and running where they used to be. That's why we're here. It's not a walk in the park to do this by yourself. It's good to have someone hold your hand while you're doing this, do the heavy lifting. The real collaboration that is only on a company's part is just getting us those financials as quickly as possible so that we can make our determination, and that's just going to speed up your refund.
Absolutely.
Nobody likes to do taxes. I'm guilty of that, right? But this is the one, but typically when I do my taxes, I'm not looking at a refund that ERC can be. So but yeah, so I would encourage everyone to take a peek. Let us take a look. If you don't qualify, you're not out any money, and you can at least tell yourself that you performed your due diligence.
Great point. And I'll just say this about taxes and how this impacts it. I think you said, Brandon, to begin with, or maybe it was Maggie one, why wouldn't I just go to my CPA and have them calculate this for me? And you certainly can do that. I'm sure they would charge you a fee for doing that. But what we have found is that it is the middle of tax season. I mean, the CPAs and tax accountants are extraordinarily busy right now, and they're focused on getting tax returns done. This is way secondary to them. Many of them don't have the expertise, quite honestly, to do this. The rules and the calculations can be complex. They're not, attuned to that, and they haven't developed that within their practice. Those are the things that we found as we were researching how do we bring this to our members. We looked at just, regular accounting firms, and not many of them had set up the ability to help, clients through this. And that's why Layton made a lot of sense for us, is because they have developed this as a full practice within their organization and brought in some expertise to really do it right. And I think this is the best approach that I would do. If I were a small business out there, I can highly recommend this process. And as I said, I keep saying, it's really a no-brainer. It's no risk. And you definitely want to take advantage of it if you can, or at least see if you can take advantage of it. Don't leave money on the table, because, profit matters. That's the name of my webinars. And you really need, I'll play on words. I'm pretty good with that, wasn't I?
Yeah.
You really need not leave these dollars on the table. The government's just got them there for you to take advantage of, and you really ought to do it. All right.
Yeah.
Anything else?
I would just say, just to echo that, Steve, like you said, it's busy season.
Yeah,
you can go with someone, you can go with a CPA, and a lot of time we've worked alongside of them, but we can deliver in weeks, and it might take months. If you look somewhere else, the audit defense is really valuable. But obviously there's a low chance there, but like Maggie said, they've extended the window from 3 years, which goes for everyone, to 5 years. So that's a long time for the IRS to take a peek if they want to.
Yeah, it is. And Brandon, you just mentioned something there that y'all didn't elaborate on at all. I know we discussed it in the conversations that we had and a part of this, but you said audit defense. Can you just elaborate a little bit on that, how you're there for these organizations, these businesses, if they do get audited?
Sure. So that's baked into our engagement with every client. And basically, for the duration of period that the IRS has to ask questions about the work that we deliver and the claim that the client makes, if they have questions and they need to back, the client needs to back something up, the the information that we deliver to them, that report is their first line of defense. But we are there to personally step in and engage on their behalf. If there's additional questions, if there's challenges, we defend our work, which is why we put it through 2-3 rounds of quality checks before we deliver. We want to make sure our biggest concern is accuracy and that we're following the rules.
Yeah.
And so that's why we offer that audit defense. We assume the risk there because we're confident in the work that we deliver.
That's great. That's great peace of mind to know that, you know, if you do get audited, which is unlikely but possible, that you've got somebody that'll help you through that and defend you in regards to the calculations and the justification that you've made. Again, thank you everyone for coming today and attending. For those of you that will view this later from the website, I hope you will also take advantage of this as well. And we'll see you next time on Profit Matters. Thanks everyone. Thanks,
Thank you,
Brandon.
guys.
Thanks, Maggie. Appreciate
Thank you
it.
so much.
Thanks everyone else.
Bye-bye.